and gentlemen, you've just seen a video clip featuring the opening of our flagship in London at Oxford Street. My name is Przemysław Ludkiewicz, and I would like to present our results for the third quarter of 2017. So we shall start with big numbers. Nearly 1,700 stores in the chain, 20 brands, very good growth, nearly 9% growth after 3 quarters of this year, with a very dynamic and a growing trend in e-commerce. So the online shops sold nearly 100% year-on-year. Therefore, the sale after 3 quarters grew by 17%, nearly 5 billion zloty. Now let's have a look at the map that you are familiar with. 2 new countries. We've added 2 new countries in the third quarter, Serbia and the UK, our flagship store at Oxford Street. So the biggest number of stores were opened under Sinsay brand, the one that is developing the most dynamically. Now, a handful of information about sales. Very good, a record-setting LFLs, nearly 15% growth. This is the best result in 3 years. All brands and all countries have recorded growth in LFLs. And additionally, we also had very good growth in e-commerce, nearly 140% growth year-on-year. And now, e-commerce is amounting to nearly 4% of the total sales, and in Poland, this is over 5% of the total sale. And now, distribution by brands, the highest growth in Reserved. This is due to good collections that were favored by our customers, especially female collection and kids collection. A very good crop autumn collection in crop. Back to school was really selling well. And of course, Sinsay, that is growing very dynamically, nearly 40% growth, new floor space, but also very good growth by per square meter. Well, a bit lower results in Mojito. We started with too high prices. That was showed in the margins. But once we've actually decreased the prices, well, the sales picked up. And House is still a bit struggling with the collection. And now distribution by regions, growths in key regions. The highest growths in the EU, except Poland, over 36% growth, new openings in Serbia and the UK. And we, of course, have good growths in Poland. 20% growth on a very saturated market is a very good result. And East Russia, Ukraine and Belarus, 16% growth in the third quarter. And the total sales, a very good sales in the third quarter, 21% growth of sales. You can see actually on the graph that this has been the best quarter in many months. And we are very happy about the revenues per square meters, 16% growth per square meters in the retail business. And you can see that in each regions that this is around, on average, 600 zloty per square meter. Now a bit about margin. A new inventory stock management policy, so that in the second and fourth month the situation will be better. That was communicated to you. But during the sales months, well, like third and first, though the odd months, well, the margin will be lower. But still, the situation, as you can see year-on-year, the situation is improving. Of course, we were additionally supported by the exchange rate. US dollar to zloty Polish zloty. You can see it on the graph, but also selling the collection at full price. There was no special need for any promotional campaigns or sale campaigns. Now let's move on to the cost. On the left, you can see our own stores cost distributed into three categories. So at the bottom, rent, then personnel, and the remaining cost, 100 zloty. This is the cost per 1 square meter of rent, higher than in the previous quarters, but comparable to the previous year, the third quarter. So the stable trend in the personnel cost, 63 zloty in the first quarter, 62 in the second quarter, and 61 in the third quarter. So despite the situation, we are managing the personnel very well. We are able to actually manage the working hours according to the traffic in the stores very well, and the other cost stable. So in total, per square meter, the cost grew by 4% year on year. So I believe that this is a very good result. So that means that our cost is under control. But the total cost is growing faster per square meter. So 10% growth year on year, quarter to quarter. So that means that, well, this is the result of the growing cost of the headquarters. So logistics connected with the e-commerce, IT departments, product departments, and one-off cost of marketing. So, for instance, opening of the store in the UK, in London, in the third quarter. So the sales margin and the cost has been discussed already. So now is the time for the results. We can see quite well how our financial leverage is working. So the 21% growth of sales, lower growth of cost, and a better margin with the help of this leverage. So the operational profit is over 100 million zloty, and net profit is 85 million zloty. This is just for the third quarter. And at the accruing cost, margin is higher by nearly 3 percentage points. So we are talking about 200 EBIT and 114 million net profit. So the most important balance sheet positions. So inventories, this is not exactly our objective, our goal, because our goal is 1,400, 1,500. Why higher? Well, because we decided to bring the autumn and winter collection earlier than usual. Why? Because during the first quarter of this year, we were a bit late with this collection. Therefore, the lower results of the first quarter, because the collection should have been in the stores in February and entered the stores in March. So we decided to actually bring in the collection, winter-autumn collection, earlier in August, and we can see that we've been proved right, because the sales is really good. So despite the fact that the inventory is exceeding our goal, well, we are not afraid that at the end of the year we will be fine with that. And now working capital, what we've communicated before, we want to have the debt equal to our inventories. We are not far ahead of that. 200 million difference between the liabilities and the inventories. So we are releasing the working capital, we are releasing the cash, and we are subsequently paying off our debt. So the net debt is only nearly to nothing, close to actually nothing, 11 million zloty. So we are not in debt. And capex investment outlays that doubled as compared to the previous years. Why? Because since we didn't open that much new floor space. Well, this is the result of the fact that we are very flexible in spending our money. Well, 2015 and 2016 was a bit not as good as the previous years. So we've decided, at that time, to stop modernization of our stores. And now, since our company is recording good results, we've decided to invest more money into modernizing our stores. stores, those that require to be refurbished. Therefore, higher capex, higher expenditure. So summarizing this 9 months, so we've entered 3 new markets: Belarus, Serbia, and the United Kingdom. We are very dynamically developing our e-commerce. We've been operating in 10 countries at the end of the third quarter, and we've opened online shops in Russia in October. And with the help of good collections, improved collections, we record good sales results, good, really high like-for-likes, and good results translate into improved margin. And this improved margin helps us to record better results and increase the stability of our company, and our debt is on a very low level. And shortly, the key corporate events. In August, we've entered a new market in Serbia. In September, we've opened our flagship store in London, and at the same time, we also opened an online store in the UK. At the same time, all five brands were opened in the new shopping mall called Galeria Północna in Warsaw. You can see actually our concept stores there, and soon we will be opening 2,500 square meters of reserved store open to public. This is the same concept as in London, so this will be opened in Warsaw in Złote Tarasy shopping mall. A handful of information about Serbia. This is yet another market in Europe, in Central. We plan to open 20 stores in this market, London. I will not be talking too much about that because we've seen the video clip, and some of you have been present with us during the opening, and we're very happy that you could join us there. It was a pleasure for us to present our store. I need to say that our store has been received very well by the press, by the media in the UK, very well in terms of our face, Kate Moss, and the sales is quite good. And now we need to actually add some cashiers, some mobile cashiers, because the 9 that are operating there are not enough. So we really want to serve all the customers. Well, the good receipt of the brand translates into a very good e-commerce there. So we invest a lot into in a logistical part of e-commerce. In October, we've opened in Stryków in Poland, together with Arvato company, 30,000 square meter of the new store, of the new service store. So we are servicing Reserved House Mojito in Sinsay for European countries. We've opened e-commerce in Moscow, in Russia. Therefore, we've opened a storehouse, a storage for that, together with our partner, and we are thinking about opening 2 new warehouses in the UK for the UK market, and one in the Southern Europe. Maybe this will be Romania, for instance, in order to support our sales there in the Southern Europe. And now the outlook for 2017 and 2018. So the floor space this year will grow by about 9%, and our target is to exceed 1 million square meters of floor space. This 1 million square meters, this is about 15 Arcadia shopping malls. So the biggest growth was recorded in the Eastern Europe, in the Eastern countries, but also Europe, Middle East and Europe. 60,000 square meter new floor space will be opened in November and December. And you can see it in all countries, Russia, Ukraine, Belarus growth, also Southern Europe plus Poland. This is the growth. So the planned capex this year is 410 million zloty. This is slightly higher than I was announcing a quarter ago, because we've decided to increase our outlays on the modernization of the older stores. So summarizing our goals, targets for 2017. So our goal was to reach the double-digit growth, revenue growth, and that we were able to succeed in that. And we really hope that the fourth quarter will be as good. Well, the margin of the group should be about 53%. Well, the cost is under control, so SG&A per square meter is really under control, and the debt is on a very extremely low level. And our targets for 2018, so major goals, but they are quite close to what we were planning for last year. So we want to continue the positive LFLs. So our goal is the double-digit growth of sales, higher than the floor space growth. The margin, we project that it should be between 53-54%, and we want to keep the debt on the low level. So what are the chances, opportunities? The further expansion, so opening on new markets, but also the further dynamic growth and development of e-commerce. Well, what are the risks? Well, the same as we've been seeing for the past months. So we don't know the situation about the trading on Sundays, whether it will be banned or not. And we've calculated that Sunday is about 18% of the weekly sales. And, well, of course, the question remains what will happen on the exchange market, so zloty versus US dollar and ruble. Next year, we want to open new stores in Kazakhstan, Israel, and Slovenia. So at the end of the year, we should have stores in 23 countries. So primarily, we thought that we would be opening Kazakhstan in 2018, but why the change? So because we decided not to use the franchise there. We wanted to actually open our own stores. Therefore, we won't be opening Kazakhstan in 2017, but 2018. However, in franchise model, we will open in Israel. And of course, we keep remembering that in the future, we would like to add at least one country per year to our geographical coverage. And now about the floor space growth. Our plan for 2018 is 10% growth of the floor space, but the biggest growth will be because of Israel. Also Europe, 22% growth, 10% growth in the CIS, and in Poland, 4% growth of floor space. In Poland, this is mostly due to modernization of the floor space. So we will be modernizing the older stores, and we will be also expanding the stores that are operating really well, that are doing quite well. Our investment outlays that we plan. So the total will be 430 million zloty, and 320 million will be spent on the stores. Now a bit about the e-commerce. So our goal for this year were doubling the sales to 350 million zloty out of 170 million zloty. And then we are keeping that, but for 2018, the target is again to double the online sale, so to go from 350 million zloty to 700 million zloty. Let's have a look at the e-commerce map. So the green color shows you the countries that have online stores at the end of the third quarter. Additionally, during the fourth quarter, we opened online stores in Russia. So at the end of the year, next year, we would like to have the e-commerce online stores in all those countries in which we have our stores operating. Again, a map, the green color covers the stores at the end of 2016. So the dark gray shows you the new countries that were added this year, so Serbia, Belarus, and the UK. And the blue color shows you the countries that will be added next year, 2018. So Israel, Slovenia, and of course Kazakhstan. So 23 countries in our chain, in the reserved brand chain. This is our strategic goal for the next year. So that's all from me. I'd like to thank you for your attention. So this is the end of the presentation during our meeting. And as usual, I welcome all the questions. And as usual, because we are broadcasting online, please raise your hand and ask your question to the microphone. And if you could introduce yourself, first of all, so then we can actually present it to our online viewers. Michał Majerski, PT Alliance. I wanted to ask you about 2 distribution centers that you are opening. You are planning to open. Will you be renting them? Yes, we are planning that. We are not planning any distribution centers that would be owned by us. So this will be outsourcing model. We want to use the experience of the foreign external companies. So there will not be too much of a capex. No, there will be no capex. There will be OPEX. So what is the cost, yearly cost of such distribution center, roughly? So we are looking at the OPEX per a piece of cloth. So the cost is close to what we are insured with in our logistical centers in Poland. So the difference is not too big. Well, the biggest cost is connected with the transportation from the warehouse to the customer. So we don't see that the cost should grow significantly. So there's nothing to focus on, really. I encourage you to ask the questions. Are there any further questions? Michał Kuzminski, JP Morgan. I have 2 questions. First one concerns the US dollar exchange rate for the spring collection, and what is the rate, or maybe part of the autumn and winter collection is secured as well. So that was the first question. Now the second one is connected with the growing e-commerce next year. Well, the collection, the margin next year, maybe you are thinking about more aggressive rollout that can actually negatively influence the margin, gross margins, because if you double e-commerce next year, then the mix will be 7-8% next year. So we are observing that some margins, the guidance has been revised, the same with Amazon. So they're reinvesting the whole scale advantage. Is that part of your strategy? Well, now answering the first question, whether we've actually hedged the US exchange for our collections, the hedgings that we are using concern only the payments. So if we receive an invoice, so we hedge this rate until the invoice is paid. So we do not hedge the margin in terms of the exchange rate. We always wanted to remove the FX differences below the profit, so the financial differences on the payment level. Now the second question, e-commerce has lower gross margins than the stationary business. traditional business. So talking about 54% margin next year, this is very ambitious because, with the growing e-commerce, we can have lower margins because the e-commerce has generally lower margins. Therefore, we believe that this 54% of the margin seems to be the best one, the most safe one. And we will definitely be focusing on improving the margins in e-commerce. Well, how about the growth of e-commerce in the Western Europe? Is that connected with lower margins of the business in general? Well, a bit, yes. I agree that this is a little bit interconnected because the online customers are looking for the best promotions, for the best opportunities. Therefore, e-commerce comes with a lower margin. Therefore, in the UK, in the Germany, so the gross margin in e-commerce gross margin is slightly lower than the traditional stores. So have you been able to purchase most of your collection for the next year, spring and summer? No, not yet. Of course, there are some pieces coming to our warehouse, but I'd say that this is not more than 15-20% of the total collection. So most of the collection has not been hedged with an exchange rate because the collection hasn't come to the warehouses. You are expecting 8-9% of inflation, salary inflation next year. So in general, the total cost per square meter, we are talking about 10% growth on average. How are you planning to do it in the next year? So the inflation of the salaries is growing, so more expensive floor space in Western Europe, maybe some one-off events and costs connected with the acceleration of the e-commerce or the operation of the flagship in London. So what do you think about the inflation next year? I can't answer that question. I am unable to answer that question because I haven't prepared a model or a budget for the next year. Therefore, my answer to that, but let's see it that way. Inflation on the store level, rents, well, we are not expecting that they should be growing much. Maybe they should be a bit lower because no spectacular opening in the Western Europe. So we have inflation that is projected at the level of 8-9% in terms of salaries, and the total costs of the stores should not be growing significantly. Well, the cost of the headquarters, logistics, IT, well, this will be growing next year. How much? I still don't know. But it seems that it will not be 10%. I believe that it should be lower than 10%. Now about rents. Do you believe that you can keep them on a flat level, taking into consideration the fact that you've just opened a flagship in London and during holidays you opened some stores in Germany? During summer holidays. Well, this is not a significant contribution here. So the rent in London, this is over 1% of all total rent. Polish rents or Central Europe or Eastern Europe, well, those rents are more significant, and well, the rents are lower quarter on quarter. We have one online question. So how many employees have you employed at the end of 2017? And how many at the end of the third quarter of 2016? Between 20 and 23,000 people. I don't really have detailed data, but the total the company hires about 25,000 people in total. So about 23,000 people in the store. So what is the referential level and target level? Well, there is no target or referential level in this business, so our goal is 1,500 zloty per square meter. So Mr. Kozłowski from Raiffeisen, I congratulate you. A very strong third quarter. Net debt 11 million zloty. This is a nice value. And I've noticed that the debt is 0 to 1, so this ratio is close to 1. So are you planning to have a decision what to do with the cash? Yes, we are close to deciding what to do with the cash because we want to keep it in our balance on our balance sheet. We are not playing any margins, no changes there. We are not taking any decisions yet. We need to hold a better financial position in terms of the financial security. If anything happens on the market, a crisis of a sort, smaller or bigger, we want to have some cash at hand in order to survive that period as a safe company without any financial troubles. So as of today, we are planning to keep that cash. And thank you for congratulating us the result of the third quarter. Well, that's fine. Are there any further questions? Is there anyone else who would like to ask a question? I don't see anybody. So I'd like to thank you once again for joining us today. And because this is our last meeting this year, because the next conference will be held in 2018. So I would like to wish everyone nice and happy holidays, Christmas, and all great time in 2018. So thank you so much.